people were so pessimistic about the local industry, the Kenyan music industry then at the time. People felt like it was for people who are failures in society. And for a graduate like myself to get into the space and show the world, not just Kenya, that this is something that's viable, it's a business. I developed that culture of depositing anything I earned. I remember going to a branch in Ruaraka, and I was very interested in getting into this premier thing. Now I understand that with your money, you can make your own money work for you. Dennis is actually my RM to date. Dennis has been very, very instrumental in some of the investments that I've made. I'm always up to date with what is happening. I'm always aware of what is new. When you start making money, if you're not good in something, like Jan and I, leave it. Go to Absa, invest in that space.
My name is Masi Gatukui. I work with the Absa Asset Management team as an investment manager. So a money market fund is a pooled investment portfolio that brings together investors from different walks of life. It has a very affordable investment minimum of 1,000 Kenya shillings, which makes it a suitable investment for a variety of investors. The idea behind a money market fund is to generate interest income through a variety of short-term fixed income securities. For example, this could range from bank deposits, treasury bills, and short-term treasury bonds. So investors who come into this portfolio are able to earn a return ranging anywhere between 7 to 9% per annum. This fund is also very responsive to movement in interest rates. So when interest rates move higher, you do tend to get a higher return on this portfolio. But when interest rates move lower, it also reflects the kind of interest rates that are available in the market. This fund is also available in a variety of currencies. So currently, we have it available in a Kenya shilling money market fund or a US dollar money market fund.
My name is Elizabeth Irungo, and I'm the CEO of Absa Asset Management Limited. An individual pension plan is an approved pension product by RBA that allows individuals who are from different backgrounds, different income sectors, different companies to be able to save together and towards their retirement and enjoy all the retirement benefits that come with the Retirement Act. The beauty about an IPP is that it also allows different people who have worked in different organizations to consolidate their pension benefits into one pot and be able to track the performance and also to see the benefits of economies of scale when investing with others. So in an individual pension plan, we are able to invest in a diverse portfolio and give you a return that is enhanced by the fact that you are enjoying the economies of scale. Thank you.
My name is Dominic Njehia, Business Development Manager at Absa Asset Management. An umbrella pension fund is a fund that we started at Absa to take care of SMEs or corporate who don't have occupational schemes in-house. The fund operates within the arms of Retirement Benefit Authority and get all the benefits of a Retirement Benefit Authority. The benefit to the organization or to the corporate is quite huge. The corporate doesn't have to go through the arms of registering a fund, and they can be able to just sign up. The final one is for the corporate within the years as you grow old and also invest for your retirement to get better return over the years, and we look at over the years and we look at what is happening within the arms of the RBA.
I am Mwenda Rarama. I work for Absa Asset Management as the Chief Investment Officer. So we do have a fixed income fund as part of the unit trust or collective investment that we offer. That's one of our mainstream funds. What a fixed income fund does is that it invests in fixed income securities, and in particular, our fixed income fund is 70% bonds. That means you actually bonds. That means you actually and this is treasury bonds, not corporate bonds. You're talking about treasury bonds, and this is treasury bonds, not corporate bonds. You're talking about treasury bonds. We are very conscious of the risk. It still needs to be considered as a long-term investment. When you're coming in, you want to make sure that you sit there for long enough for the price movements to actually happen, and you benefit from that, and also the long-term income that comes. The minimums for all our unit trust funds remain the same. So the minimum for the fixed income fund is 1,000 shillings. So if you do have 1,000 shillings, visit any of our branches, visit us, open an account, invest the same, and you should be able to participate in this kind of returns that we are seeing.
All right, a very good morning to you, wherever you're joining us from. Welcome to the Absa Bonus Edition webinar. This is where we'll be having conversations about the opportunities that you have going forward during this season as you receive your bonuses. Where do you put that money? My name is Jimmy Mbogo. I'm a Bank and business journalist here in Kenya. And for today's session, I have the privilege of steering this conversation. Now, in case you're wondering what this Absa bonus webinar is all about, and just allow me to take you through this. And this is a series of conversations aimed at helping you, our customers particularly, to make better decisions, particularly on where you spend your money. This, you might be asking yourself, why is this important? And I will tell you, one of the things that this will help you with is to make sure that any one of you who's receiving a bonus during this windfall season has options in terms of where does that money go, what are some of the opportunities out there that you can tap into. We'll also help you in terms of just prioritizing how you spend these bonuses, from as little as 10,000, 5,000 to as high as your bonuses are. We will have a solution and an option for each one of you, and we want to take that headache away of just looking for what are the viable opportunities out there in the market. And to help me with that conversation, I have a panel of experts from right here at Absa Bank who will be helping us with that conversation and painting a picture for us in terms of what the macros look like, whether globally, locally, and also what are some of these options that you might be having. And help me at this point now, allow me at this point to welcome my panelists who are here with me. And I want to start from my immediate right. This is Elizabeth Irungu. She is the head of Absa Bank Asset Management. Elizabeth, good morning.
Good morning and welcome our customers
All
to
right.
today's webinar.
Yes, we also have Mr. Mwenda Rarama. He's the Chief Investment Officer, Absa Bank Asset Management. Mwenda, good morning.
Good morning.
Are you ready for our chat?
Oh, yes, we are.
All right, wonderful. And we also have Mr. Eric Idali, who is a Wealth and Investment Manager right here at Absa Bank. Eric, how are you feeling this morning?
Great, excited, ready to have this wonderful conversation.
All right, and I think, wonderful. And I think we'll get straight into this conversation. And I want to start with Elizabeth, who's right here on my immediate right. And Liz, one of the things that we really want you to help us understand, there's so much happening, whether globally, locally, but I want you to help us set the stage in terms of what is happening globally, what are the opportunities out there, and what is the ripple effect of what is happening globally that is likely to affect us here in Kenya.
All right, thank you very much. I start off by first of all acknowledging each one of you for joining us this morning, and to say that we are living in a world which is going through a term that was coined some time back, VUCA, volatile, ambiguous, complex, and it's just complex, and you may not understand it. I think there's a lot that's going on, so I want to take you through what we are seeing in the global markets, which of course we cannot ignore. Everything trickles down to what is happening around the world, and it shapes what we do as investors. So as I slide to the global markets, sort of slide. Okay, here we are. Looking at that world map there, we are seeing the geopolitical risks have just evolved to even higher levels. We are saying we are at a crescendo on geopolitical risk. I think that materialized immediately. We saw, the US and Israel launch extensive strikes against Iran. And while we were hoping that this was going to be short-lived, unfortunately now we are on the third week of this war, and this has changed the perspective around the world. We cannot forget that in January we had the Venezuela situation. It's still evolving, it's still going around, and as you can see from the map there, the geopolitical tensions across the world are so many. Those are the orange dots that you're seeing there. We are seeing a world that is actually disrupted quite a bit, and therefore decision making, whether you're an investor, whether you are a business person, or even just in your personal capacity, becomes quite a complex matter. And we are saying, for the investor, what do you do when this kind of situation snowballs right in front of you? Some of it expected, some of it really out of the ordinary, and the repercussions touch many different sectors of the economies across the world. Who suffers the most? Where the opportunities are when such things happens? Something that you'll notice is that the economic growth projections are still strong. Globally, the economy will still be expected to grow at 3.1%. We find that the developing economies, which Kenya would fall in that category, is still expected to lead in terms of the performance. And so overall, we are saying that the GDP performances are not going to significantly come off, but definitely structurally we would see a world that is much more different than what we have enjoyed in the last many years. So what happens? And my question is, what happens when the disruption is touching one of the major resources that is used in most world? 20% of global oil supply has been affected by the war that we are seeing, the current war, the Iran war. That is going to mean that economies have to shift. The way we operate and the way we work with different other, international players has to shift. So trade is one of the things that gets to be affected directly. So we see the over-reliance on the Middle East getting impacted, and we think that that over-reliance there has to be a diversification story. So we believe that economies are going to take it more seriously when it comes to using alternative sources of energy, of course, and that's long term. But in the meantime, we will definitely have the impact of the high prices of energy coming in and trickling into the economy and into the goods and services that we consume in the different economies of the world. Already that is happening. I think Kenya was shielded when we saw the oil prices announcement last week. They did not change, but that doesn't mean that is a permanent situation. It's going to change, and we will see ourselves definitely being affected because supply chains have been affected, and that means even other goods will see a bit of change, and also matters to do with insurance becoming more expensive, the timelines for shipping becoming longer, so you get the impact trickling down to your household, even if the war is taking place miles and miles away from us. But what is important to investors is, how do we behave? How are people behaving in times like these ones? So there are two ways to look at it. There are those who will react on the short term, and then there are those long-term investor behaviors that will emerge. So if you look at the short term, and we've already passed that phase, which is usually days and maybe a week after a crisis has come up, you find that emotions will run high. And the emotions of investors are demonstrated by how markets will perform. So you find panic, there is fear. So immediately the war happened, you would recall that oil prices hit all the way $109 to a barrel. And that tells you there was panic. But after that, the oil has steadily, been trading range bound. rebound, which tells you that the fear, the panic is actually coming to an end. But that doesn't mean the trajectory has changed. The trajectory is actually positive, but the panic has actually started abating, and investors are reacting with more, clarity. And that's what we like, that there will be clarity once people find the bearing and the new equilibrium of what is happening. In terms of strategy, which is the second thing, we see that in the short term, most people exit in a hurry to try and preserve their capital. And it's not abnormal. However, that's natural. When you're investing, you have to recognize that investors are behavior. They're very emotional, so the emotional part of it will always come in. The first instinct is to make sure that you exit anything that looks really precarious at a point of crisis, and you try to preserve your capital as much as possible. Then the third thing that happens is the asset preferences. How do people, what assets do people then prefer? I think I even forgot one. Safe assets, we could have put there gold. People run to gold, silver, and cash. So everybody's saying, now I need more cash, I need more gold, I need more silver. So if you look even in the tables internationally, you find that gold, silver, they have actually been trending upwards because more investors are actually allocating, or the new monies that need to be redeployed, they're first of all landing in the safe assets before being redeployed. It is a normal thing because you need to unravel the outcomes and the long-term impact of the crisis that you are going in. And you'll recall even during the COVID period, that same thing happened. The markets actually crashed. This time round, I think we did not see the markets crash, but we saw the markets go down. Behavior-wise, we are reactive. That's in the short term. Everybody is reacting. Let me tell you an example. I think when it happened and the war in Iran snowballed, and it was very clear that Iran was going to was reiterating by fighting with the neighbors. Most people wanted to exit the Middle East, and we saw some people paying tickets out of Dubai up to $350,000. That's a crazy, astronomical number. You would never buy a ticket at that price, but because you're reactive, you're thinking death is near me, I need to really get out of this place, such kind of prices actually become real, and they are now in the records that indeed you can pay a price of $350,000 to get out of an area that is ordinarily one of the cheapest exit routes when it comes to travel, air travel. So that's reactive. Have you also reacted? Ask yourself that question. And then the time horizon, it's usually immediate, it's more about survival, and all the things that investors will do. And even when you watch the screens, the Bloomberg and all that, you'll find people are reacting more for the immediate survival, because we still do not know to what extent things will go. But what is important to note is that while all this is important and we are not undermining the need for survival during a crisis, you need to look at things in the long term. We need to anchor on what will happen or how things will pan out into the future. Maybe the new normal that will happen. So emotionally, you need to be as we enter the long-term season, we need to still to start being more, to have cautious optimism, and that means you're not ignoring the fact that there's a crisis, but there's optimism towards how you are managing your money and how you are making decisions, whether they're business decisions or personal decisions towards your investments. Then in terms of strategy, where people will start re-entering and growing, we have seen people who are looking at opportunities that are arising. Case in point, you find that let's say, for example, we're finding if you are offering alternative, energy sources, I think that becomes a big opportunity, because people will start re-entering and looking for growth areas that are out of the crisis situation. Asset preferences in the long term, it's more about diversification, because crises will come, and they will come, and they're coming more frequently than we have ever experienced. So we are living in a very different time. And when I said VUCA times, it really is VUCA times. And so even your portfolios need to reflect the fact that crises are coming much faster, much shorter. And so your time to respond and to anchor your portfolios are much limited. And for that reason, you need a diversified portfolio. So this being, I think, since 2020, maybe our fourth crisis that we are going in as an global world, diversification now need to have sunk into most people. And I believe that this webinar will help you to even think harder about your portfolios being better diversified, and diversification happens at geographical levels, at your asset allocation levels, at also at the asset allocation levels, so the assets that you pick, and of course the geographies that you are in. The behavior should be more strategic. If you stop being really reactive, you should be more strategic, not what we call actually, let me just use the word reactive. So your portfolio should not be a knee-jerk reaction where you see that maybe, the stock market when the Iran war came, I think went down in Kenya at 2%. You shouldn't be part of the people who are panicking and selling off everything. You could maybe be strategic and say, what are the sectors that are going to suffer the most? What are the sectors that are going to benefit the most? And you strategically allocate your resources accordingly. And that way you build. Now look at the bubbles that are on the right there. Global markets performance. We have seen more resilience than volatility. So we believe that the markets, because of going through several cycles of crisis in the world, we are seeing more resilience than a reactive behavior among investors, and not only in our emerging markets, which are leading there, which is quite good. Even in the developed market, the US, which is the biggest market and tends to be quite reactive, we have seen the S&P 500 only decline by -2%, which is quite interesting, because if you compare with what happened in during the COVID crisis, we saw the S&P 500 actually go down quite significantly and impact people rapidly, but the recovery was also as fast. In this time round, we are seeing all the markets have been quite resilient, and we expect that that is likely to be sustained. However, be careful, because the volatilities will continue being there, because we are getting new information as the crisis evolves, and as as the world gets the new bearing of how will things pan out. But key drivers that we are watching out: economic growth is still expected to be strong. Another driver for the resilience, we believe, is the strong corporate earnings that we are seeing not only in Kenya but across the world. We've seen the earnings reports which have been released being quite strong and really supporting the valuations that are currently in the market. And then investors are more optimistic, more indicating that they have taken a more strategic view about markets rather than being panicky. Thank you very much. Back to you.
All right, thank you very much, Elizabeth, for painting that picture. And I think that's where I want to bring in Mwenda into this conversation. Now, Mwenda, what we are sure now is that, and as Liz rightfully says, crises are coming in more frequently, that volatility is becoming something that businesses and economies have to deal with on a regular. Now, when you bring this conversation to the local level, to the Kenyan setup, how is 2026 looking? Because the impact of what is happening in with Iran, Israel-US war is likely going to be felt right here in Kenya and in the region.
Thank you. And in a world that is extremely unstable, then as a country, one of the things that you need to do is figure out how do you insulate your people against some of these issues. One of the things that we saw with COVID is there was a lot of reaction at the very beginning, dealing with it as if it was a financial problem, yet it was a health problem. For the countries that actually dealt with a health issue as if it was a financial problem, created a lot of money, there was a supply problem, we ended up with inflation, quite a bit of it. That insulation is something that each and every economy must work towards. So Kenya, over the last Saturday, we did discuss this in our last webinar as well. Kenya has gone through, as of course, a lot of structural issues, but the issue is, are we fixing them as we progress? So from a GDP point of view, do we have diversity? Yes, we do have diversity. There has been quite a bit of diversity economically, because agriculture used to be our bread and butter. It's not that it has shrunk, but we have seen the other contributors to GDP grow quite a bit in terms of significance. The other question is, how are we managing both internal inflation and as well as imported inflation? So I'll kick off with the internal inflation. One of the biggest drivers has always been the cost of food.
I think that with the rains has abated. We have seen inflation come down. We do not expect, we did yes have a drought, but the rains are here now. We do not expect to have a pressure in terms of food prices. So let me just shift gears to imported inflation. So it comes to imported inflation, there are two things that lead to it. One is, of course, the currency. So any weakness on the currency, anything that you import in becomes more expensive and, of course, has an impact. So one of the things that we have seen is the fact that oil prices are up, and Elizabeth did speak to that. With a more unstable economy, we'll definitely have a lot of volatility in prices as well. So that volatility, how do you insulate against it having a double impact? Because if you have a weaker currency and you have a higher price on the commodity that you're importing, then you do actually have a double shot kind of scenario where you end up having an incremental price because of the currency alone. So you have seen stability on the currency, and that stability is what we are seeing on our left. Starting from March of 2024, we basically have seen a lot of stability on that currency. What has that done? It has actually enabled CBK to raise quite a bit in terms of reserves. As a business owner, as someone making decisions, you know when you need the currency, it will be available. So you don't need to stock up, you don't need to build up any dollars because you know the price is not changing, it's predictable to a large extent. It makes it a lot easier for you to make business decisions. When you need the currency, you will find it. If you need to sell it, then you know the price that it's going at. So it takes away the uncertainty that a currency that is has a lot of movements. But the question is then, given that we still have structural issues, we still have a lot of fiscal challenges that we're still facing as a country, then are you able to still, in the short term, be able to defend that currency? The defense of that currency is based on the reserves. We now have a 6.2 months reserve, that is the graph on your right. That tells you that we have had a significant jump over time. This is the highest we have seen in quite a bit of time. The last times we were at almost 6 months of import cover was way before COVID, the period of March of 2018. But in 2021 as well, we did have a period where the government did build quite a bit in terms of reserves, most of it coming from the fact that they have issued Eurobonds. We did see a Eurobond issued as well that has boosted the reserves. That enables you to be able to still have the currency available for any imports you have without having an impact of your currency, without having to come and build a lot of demand as such, that demand can be met by the reserves that are available in the country. That, of course, has a major impact on imported inflation. Now, the other thing that impacts what we see is capital flight. Over the last couple of years, and this goes all the way to 2019, what you are seeing is that we have seen quite a bit of foreigners exit the stock market. A lot of what we now have is participation by locals significantly. Before COVID came, we did have a significant portion being foreign owned. Foreigners were very excited with the emerging market stories. Things were doing well. There was a lot more stability. You remember the days of the IPOs and post-IPOs. And of course, foreigners stayed and they built quite a bit in terms of portfolio. And to some extent, in some institutions, they built up as high as almost 40% of ownership in some of the listed institutions. That tells you that interest was there. But what have we seen since the COVID period? A lot of it has been capital flight. That hit us quite a bit during COVID, post-COVID, because a lot of that, of course, means demand for dollars is there because foreigners will only exit. When they do sell this, there's demand for the currency, and that currency is basically being shipped out of the country. So that creates a double-edged sword. You have a stock market that is being hit by a lot of exits, but you also have a currency that is getting demand because the person who is exiting the stock market or any other investment locally is also looking to get currency so that they can move out of the country. So what we have seen, and that's why you're seeing a lot of red, negative, this is basically net flows. All through from 2020 to now, we have seen quite a bit of significant exit by foreigners. Then one of the things that has also happened in the last 2 years, we have seen retailers coming back into the market. The average Kenyan is back into the market, is actually a participant in the stock market because the last 2 years have delivered very good performance. 2024, 2025, very good performance. And if you look at our equity fund, last year we did deliver 40% return. That tells you that we have strength. It's not because the institutions have actually, because Elizabeth spoke about the economic side of it and also the corporate earnings. What we have seen is increasingly our corporates have become stronger, have become more strategic in what they do, in the kind of business they do, whether it's banking, whether you look at Safaricom, whether you look at ABL, the kind of business that they are doing and how they are doing it has created a lot of stability as well. And their growth has been phenomenal over the last couple of years. But that was not showing in the stock market because the activity has been very low. We did not have price discovery. So over the last 2 years, because of the interest that we have had, then we have had a lot of price discovery, and some of those very strong fundamentals that we all see, banks have been releasing results. We have seen some of those results phenomenal in terms of performance. That needs to show in the price. With a depressed market, you don't see it in the price. But in a market that is actually active, then we do have proper transmission of those fundamentals. So fundamentally, economically, the country has continued to grow from an economic point of view. The corporate earnings have still continued to grow to a large extent. We have a lot less in terms of foreign participation in our market, which provides a lot of insulation to the currency and to anything that has to do with imported inflation. Yes, we know the oil prices have not been adjusted, but we all have the cognizance of the fact that oil prices have gone up. How the government reacts to it, where they have capacity, I do believe they have built capacity enough to be able to weather some of these storms. But that doesn't take away the fact that we still have structural fiscal issues that we need to deal with. Jimmy, thank you.
All right, thank you very much, Mwenda. Now, I want to bring Eric into this conversation. Now, Eric, where you sit is at the investment desk. You are right at that position where you're engaging with a lot of our customers in terms of just looking at where should I put my money and talking them and taking them through that. And I want you to help us understand, based on what you've had from Elizabeth, based on what you've had from Mwenda, in terms of the risk and in terms of the volatility that is currently going on globally and also locally, there are also opportunities for investment. And I want you to help us now understand, as I look forward in diversifying my portfolio, what are some of the key things that I need to start thinking?
Okay, so Mwenda and Liz have painted a very nice picture about what has happened globally as well as locally. And the thing with the investment vehicles is that different investment vehicles will work differently in different scenarios, right? So you'll find certain asset classes in terms of volatility perform well, certain asset classes in terms of volatility don't perform that well. And the thing an investor needs to look at is that, one, what is my risk profile? Because investment options are far and wide. So risk profile is one very key thing. Secondly is what is my objective. So you'll find many a times people invest in solutions which don't match the objective, right? So there's always that mismatch between what the product is supposed to do vis-a-vis what my objective was. The other thing to look at is also the liquidity. How quickly can I get in and out of this investment vehicle? Last but not least is my time horizon, right? So in the investment world, you'll find solutions are categorized in certain classes, right? And each class has its own pros and cons. To start off, in terms of volatility, whenever there's a bit of uncertainty, most people tend to park money in cash or near cash solution, as Liz articulated. And that's where now the money markets come in. Money markets are one of the most popular, even here locally, solutions. Because in essence, what a money market does is that it pulls money from different investors. Then a fund manager, like Absa Asset Management, deploys that money in instruments which are very safe. So instruments like T-bills, bank deposits, and a few high-grade commercial papers, right? So you'll find from a volatility perspective is very balanced. There's not much volatility. The return expectation on that is it beats inflation to a large extent. So you'll find a range of between 7 to 9%. You look like at our Absa money market last year, it did about 9.5%. And with money markets, there isn't a lot more in terms of monitoring. It's very passive, and it's very prudent for three types of scenarios. One, whenever there's a bit of crisis that I'm not certain where to park this money, it's a good place to park money as you try to monitor the situation as it occurs. Secondly, it's good for goal-based savings. That means I need to travel next year, I need to pay school fees next year, I need to make a down payment on a car next year. It's ideal for that sort of planning. The other way is that it's a pit stop. You know the way in Formula One you have a pit stop? So it's a pit stop whereby as I want to grow into the next asset class, where do I accumulate enough money to go into the next asset class? And that's where now the money market comes in. Very low risk. Tenor tends to be anything within 2 years time frame. If you have a 2-year time frame, that is where you would park money in a money market. The other aspect that Mwenda has also mentioned is around our bond space. So when we call it fixed income, the secret is in the name, fixed. So it implies I'm investing whereby I'm getting a very predictable, regular fixed return. And this is where now the bonds come into place. So bonds, in essence, are debt instruments. So I, as a corporate, like you saw recently, EABL and Safaricom issued bonds. I want to expand, I want to do a project. So I come to the public and say, I want to borrow money from you. You give me this money for this period of time under this market condition, under these return expectations. So that's what the bonds come in. And bonds can be either issued by corporates or as well as government bonds. So to focus mostly on the government bonds, because that's still a very popular investment vehicle, is that in essence you're lending money to the government of Kenya. So I'll take an example. So government of Kenya says, you give me your money for 5 years and I'll pay you a rate of 10%. So assumingly, if I give the government of Kenya 10 million, it means I'll be getting 10 million multiplied by 10%, that's $1 million bob a year. That's $1 million is divided into 2. So every 6 months, like clockwork, I get my $500,000, $500,000, $500,000. So again, the $500,000 is fixed and it's predictable. So you can't actually plan for that money. And a lot of investors, what they try to do is also that, as opposed to just getting one bond, I can't curate a portfolio, because the 6-month cycle generally works like January, July, February, August, March, September, April, October, May, November, June, December. So as opposed to putting my 10 million in one specific bond, I can't come to an asset manager like Absa Asset Management and get a portfolio of different bonds that pay different times of the year. That way I have cash flow coming in every so often, because that is what is financial freedom, whereby you have created passive income, either enough to replace your active income or to a large extent support you. And this is very critical also for people who are about to focus on retirement, because at retirement level, the main ask is cash flow and healthcare. So how do I mitigate the fact that I'm no longer active, I'm no longer running a business, I'm no longer doing active employment? And if you look at our last webinar, there's a segment where Mwenda and Elizabeth took a journey map of somebody in their 20s, somebody in their 30s, and somebody in their 50s. And you'll find different asset classes, their allocation will differ based on where I am at in my life. So for the viewers, if you had a chance to look at our last webinar, please revisit it, and you'll have a very comprehensive lifestyle sort of investment. In terms of the next asset classes, we're looking at equities. So equities, in essence, you're buying ownership in a company with the expectation that, one, this company will perform very well, and two, I'll get a part of the profits that the company is delivering. So you buy a company like, say, Safaricom or Absa, most of them are listed on the Nairobi Stock Exchange. At 5 shillings, the price moves up to 10. That's what we call a capital gain, right? At the same time, as companies declare their profits, they say, we will distribute part of this profit to the clients, and that's what is called dividends. So when you invest in equities, you expect two sort of returns. One, either a capital gain in terms of the company performing well and the share price going up, or secondly, dividend in terms of them distributing their profits. So Mwenda has mentioned about how our stock market has performed last year. So Nairobi Stock Exchange was one of the most best performing in Africa. I did think they did in the north of 50%. So, and that has come through a lot of intentionality in that, one, there's a lot more information being cascaded to the public. Two, there's a lot more retail investors participating. And then three, there's some intervention that the NSE has done, sort of like breaking down that the minimum share you can buy is 1 now. Before it used to be 100, and that used to lock out a lot of people. Now you can do it at 1. But as a normal common investor, do you have the time and the headache to track which share do I buy, which share don't I buy? That's why now the equity funds come in. So equity funds, in essence, is a pool whereby the fund manager invests in shares. So you as the investor don't have the headache and the hassle of thinking, where do I buy? Do I buy this? Do I sell this? That is the work of the fund manager. And at Absa, we have an equity fund which performed significantly well. I think Mwenda was being modest when he said 40s. I think it was 48 plus. But that also gives you an exposure to the Nairobi Stock Exchange. And you can see the level of corporate earnings that have been declared, right? Through even from the financial sector. That's a good area of focusing. The other aspect is that from a currency perspective, and sorry, let me take you back to the bonds a bit. So on the bond space, Kenya issues 2 types of bonds. The government of Kenya issues 2 types of bonds. So we have the Kenya shilling bonds, which in essence, pay you on a regular basis, but you still have the euro bonds, right? I know the name might come with a bit of heat, but the name euro bond just implies it's a dollar-based bond, right? That has become very popular over the last couple of years, largely because there's a bit more currency diversification. A lot of people now are focusing more on how do I hedge myself, I think, the Kenya shilling, how do I start earning some hard currency in dollars? So Kenya has about nine of them, different ranges in terms of where they're maturing, but the minimum quantum size is $200,000, right? But for that quantum size, then again, that's where the fixed income funds come in, whereby you can have a fund manager who gives you indirect access to some of those solutions. To cross borders, offshore investment is another key consideration. So there you are having more exposure in terms of the global market, right? You have more exposure in terms of asset types, currency, whether you can do it in dollars and pounds. Because the thing with an investor is that you should never have one currency. You should always try to balance that money in different currencies, and especially the hard currencies tend to have a store of value. So that's where now the offshore investments come in. And at the moment, you'll find instruments like structured notes, which is some of the instruments that we offer. They give you a bit more hedge in terms of any volatility, whereby despite markets dropping, there's still a payment that comes through. So as a bank, we have basically partnered with investment banks offshore to run our offshore investment, right? And there you are instruments known as structured notes. So in essence, they are issued in dollars and pounds. Minimum quantum is $50,000 or pounds, and you're potentially earning double digits returns, right? And the hedge around that is that I don't have everything concentrated in Kenya. The same famous statement of diversify, diversify, diversify. So I'm diversifying, one, from a currency perspective, two, from a regional perspective, and lastly, also from an asset type perspective. So that in case of any market conditions, be it the good times or the bad times, my portfolio overall is in a balanced situation. But to wrap it up in terms of how do we position this, there's a whole conversation which we need to sit down with an investor just to identify what is their need, what is their goal, then we make a proposal. So it's not a matter of you have a full buffet that you select from. It's an actually very need-based sort of discussion.
Yeah. All right, and Eric, I'll be coming back to you with another question in relation to what you've just said. But I want to remind those who are following this conversation online that you have an opportunity to be part of this conversation. All you have to do is go on the chat and send in your questions. The hashtag to use is a legacy of wealth. In case you're on X, a legacy of wealth is the hashtag that you can use. In case you're following this conversation on YouTube, just go in the comment section and post your questions there, and we will be making sure to fill those questions to the experts here. And now, Eric, allow me to come back to you with a question on, for Jimmy here, who's not a sophisticated investor, who's debating between the bonus that I've just received, I'm debating between going into corporate bonds or going into government paper. What are my options and why?
Okay. So Jimmy is the non-sophisticated or sophisticated. So one, I think the objective is always what matters, right? Because different investment options work differently. So when you ask from a bond perspective, or corporate bond or local bond, what your answer is, are you looking for income? Are you looking for steady income, steady passive income that is coming through? So at the moment, with rates sort of in a low interest rate regime, you'd have to find that a decent, consideration would be some of the high yielding bonds that are available in the market. Because we have access to the secondary market, whereby in essence, you are buying bonds which are already running, bonds which are paying a premium, bonds which can be customized. In that, if your time horizon is 5 years, there are portions for that. If your time horizon is 10 years, if your time horizon is 20 years, or even if you have a specific month that you do want a payment. Because there are people, let's say, who you pay, assuming Jimmy pays school fees every quarter, you can curate a portfolio that pays you on a quarterly basis, right? So from a bond space, there are options are many, different tenors, different sort of returns, but the key thing is that if you can achieve a sort of a portfolio which pays you more on a month-to-month basis, that would be the first consideration. But as you think about what to invest in, that's why now you should put money in the money market, because money tends to itch. When you have money in your pocket, you tend to utilize it. So park it in a money market as you think and contemplate, how do I deploy it into different asset classes, as you also empower yourself from an informational perspective.
All right, and I saw Mwenda nodding his head. I think he has something to add on this. And Mwenda, even as you add on that, maybe you could also talk to us about this diversification. And when I'm thinking about a money market that I want to park my capital in for a period before I make that big move and decide where I want to invest in, what are some of the key elements of this money market fund that I need to be thinking of so that I also minimize my risk?
Thank you, Jimmy. And when you talk about corporate or treasury or government bonds, then the question is, as a lender, who are you more comfortable lending to? Is it a corporate or is it the government? Where do you think the risk is lower? Where do you think you have a lot more sight in terms of the level of risk? And what kind of return are you expecting to earn from either of them? Now, one of the things that we also need to wake up to is the fact that when you have a heightened risk environment globally, that of course also creates a lot of risk locally, which you have also seen. So you want to make sure that at any one time when you have high risk levels, then you don't want to take too much risk. You'd rather lend to the most stable entity, lend to a more stable pair. The same way, if you are lending to individuals in an environment where you know businesses are not doing too well, you have challenges here and there, then what would you rather do? You would want to lend to the person who you know has a lot more in terms of capitals, has a lot more in terms of capacity to pay. But then again, the person who has a lot less in terms of capital, you can charge them a higher price. So the question is, the corporates that are actually looking for this money, what kind of price are they paying vis-a-vis what the government is paying? So the stronger corporates, of course, would be almost quasi-government and will not give you a higher return. We have not, the ones that we have seen raising money in the recent past, the EABL, the Safaricom, when you look at what they offer in terms of return vis-a-vis where the government is at, the risk you're taking, you're probably not being compensated properly for it. So you'd rather sit with government in certain situations unless the corporate is compensating you for the extra risk that sits with the corporate vis-a-vis the government. Now, when we talk about windfalls, and one comedian once said, money has a way of talking to you if it's in your pocket. So you need to make sure it's sitting somewhere as you make decisions, because if you keep it in your bank account, you're swiping your ATM, end result is you probably will spend it. And money market funds are meant purposely to provide you an opportunity to think about this money as you make the decision. Before the decision is made, where do you park that money? And that's the reason why money market funds have a lot of liquidity. You can get your money within 72 hours. They have low minimums. They are a savings vehicle. They are not necessarily an investment vehicle, but more and more of a savings vehicle, where you put money, you accumulate money, and ensures that you're not risking any capital. Because as well, before you make a decision on this money, you want to make sure it remains as a lump sum. Because the moment you start chipping into it, whether by taking too much risk into an investment and you don't have a long-term view into it, during that short term, and Elizabeth did paint a very good picture of the short-term thinking and the long-term thinking, during that emotional period, you do not want to make any decisions during that emotional period. So where do you keep this money so that the emotions die down and you now can have a proper, rational, long-term view and look at all the options available, where else it's earning you something. Because if it stays in your bank account as well, if it sits under your mattress, it doesn't earn you anything. So the money market fund ensures that the money remains available when you need it, but it actually is earning you something, because if it is not earning anything, it's losing value at the rate of inflation. Yeah. So you want to make sure it sits somewhere and you park it. All right, so
Mwenda, just before you close on that point, so as a customer, what are some of the things that I need to look at before deciding that this money market fund is the one that I want to put my money in? What are those key critical elements that maybe as a customer who's new into this sort of savings I might miss?
Thank you. And Jimmy is asking me to do an analysis of the industry. Which is and
you can just give us the characteristics,
different money market funds have different levels of risk that they take. What determines risk, and I know we discussed a lot of this even in our previous webinar, what determines the level of risk that is sitting in any fund is the underlying assets. What has the investment manager actually bought for this fund? Where are they investing this money? So depending on where the money is invested, that determines the level of risk that you are taking as you invest into the fund. And that also determines the level of return that you expect, because returns come from the risk. But we need to be alive to the fact that this risk can also materialize. And therefore, if it does materialize, it comes with a loss. And that loss will impact your capital. So if you're going to a money market fund, you're looking for safety. You're looking to make sure that as I think about it, I'm not losing anything. I need my money safe. It's not a return discussion. It's more and more of a safety discussion to ensure that, one, inflation is not hurting you, and your capital is also not disappearing. So you want to, it's meant to be a low-risk vehicle to provide that kind of a setting. So when you go and evaluate the underlyings, then you need to make sure that the underlying assets have the same kind of matrices. Deposits, capital is not lost. You have a return that is coming in. It's above inflation. A bond, on the other hand, is a very different vehicle. A bond has price movements. So when rates go up, you'll actually lose in terms of capital, and that impacts you. So if you're looking for safety in your capital, then you need to be very cognizant of the fact that whatever fund you're buying into, make sure the assets meet the objectives that you have. If your objective is safety, your objective is to park money there as you make a decision, make sure your capital is safe, then you want to make sure the assets as well are assets that provide that. So lift the veil, look at the underlying, and make sure they do meet your objectives as well before you put your money into a fund.
All right, now I want to bring Liz back into this conversation, and I could see her agreeing with a lot of the comments that have been coming in. Now, Liz, in your presentation, one of the things that you talked about is some of this, the risks that we are currently facing, the volatility. We're talking about wars, we're talking about trade tensions, we're talking about supply chain disruption. But the question that I want you to help us understand is, how do we position ourselves amid all these risks? Because with every crisis, there's also an opportunity somewhere in there.
Okay. Now, that's a good question. So the crisis brings uncertainties and things like that, and disruption. So one of the things and fundamentals of stability in your financial journey is to ensure that first, you have created a buffer to protect yourself should things pan out really ugly, because they can pan out ugly. And one of the ugly things that the world is trying to prevent, and we've had it being spoken even at the UN, is inflation. That inflation will go up. It means that your purchasing power of your shilling or your dollar is going to be disrupted. So you need to have kept aside enough emergency fund. And the rule is very simple. If you're single with no dependencies and that kind of thing, ensure that you have your 3 months of emergency, and that should be sitting in a liquid form, because if you don't have it in a liquid asset class, it could mean that when you want the money, you will not be able to get the money out. So your money market funds, your bank deposit, savings account, not CASA, your savings accounts make sense for that type of emergency fund. Then the other one is for people with dependents. Those of us who are parents, our costs and our expenses per month are actually huge, and therefore, for that reason, it is recommended that you should have at least 6 months of your emergency fund. If you've not started, it is okay to start even now, because the realization has come. So don't guilt trip yourself. Just start it off and start building that and keep it safe. Other than that, you're all on a journey of building wealth. During crisis, we go through cycles, and we go through what we call volatilities that present opportunities to get into markets or into growth assets. As it was explained, the growth assets will give you long-term growth, but you need to have the resilience to stay through the season of volatility. What do you buy for that growth? You buy equities, a breadth of equities, and what happens here is you need to have a professional manager helping you to choose the right portfolio, to curate your portfolio such that it is a resilient portfolio that is anchored for future growth. That is what we do in an equity fund. If you're starting today, and if you want to go directly to the exchange, you definitely have to do a lot more research, empower yourself with information and knowledge, and build a portfolio that is resilient. That doesn't mean you don't get into your properties and all that. Evaluate your portfolio in totality and see what percentage is sitting in a certain asset class and the next asset class. If you need to replace your income, you need to buy your fixed income fund and your bonds to make sure that you diversify. Now you're affluent. When you're affluent is a different conversation, and that is what we're seeing my colleague Eric talking about. We need a personalized portfolio discussion so that we can help you see the full picture and start reallocating and rebalancing your portfolio to fit you, because now we are not talking about somebody who is dealing with liquidity or near needs like expenses. But most Kenyans, we are at that point where we need to safeguard survival. So survival will be safeguarded by making sure that you're investing with a mindset of ensuring that you can live next 3 months, next 6 months comfortably, and at the same time a part of your portion is growing. Yeah, so that's the kind of engagement you need to have. It's very intimate and it's very close, and we are available for that kind of conversation to help everybody build resilience around their wealth and growth around their wealth. And finally, maybe something that is not in the capital markets is really to speak to the younger generation. You must also invest in yourself. It's a very important thing that we consider ourselves as a first investment, because we have to make the first savings that we will use for building the portfolios. So investing in yourself means that you are getting the skills for the future, skills that will take you to the next level, and therefore making sure that your income generation capability is rising and you're not being disrupted, because the world is getting disrupted even at a skills level. So very important that you look into that, especially if you're a young person, but that doesn't eliminate the rest of us, because we must be ready for a future that is really looking different even as we speak here. Yeah.
All right, so Elizabeth, before we get into the questions, and I can see a number of questions that are coming in and a lot of interest that is being generated out of this conversation, I want you to help us understand, for someone who is earning here in Kenya, and I'm looking at getting into the global market, based on the volatility that is currently there, should I work on reserving this capital? Should I invest in something locally? How do I then weigh what decision to make, particularly on whether to get into the global market or to reserve that capital for now?
Okay, good question. And I still continue to be very conservative in saying it's a one-size-fits-all, because it isn't. Investment is not a one-size-fits-all. But if you're going to the global market and you want to extend your investments beyond Kenya, look at an index that is giving you exposure to large sectors and industries across the world, because then you will be anchored to ride out the volatilities that come, rather than, say, for example, chasing oil at the peak. You know, like you say, I'm going to buy oil because now I know I've had people talking about $200 per barrel. So oil sort of seems like it's an in thing, or gold may go to 10,000. That's speculative. So I'd really discourage anybody from going to a speculative portfolio. Rather, in a world that is disrupted, I would stay more diversified and gain across the spectrum than gain or try to chase or time the market, because one way of making wrong decisions is chasing stocks at the peak. In this period, the stocks that look like they are going to be really outperforming is, say, oil, because there's a whole conversation of $200 that is coming. So you could think, let me buy, but you'll be buying at the peak.
It's very enticing for sure.
It is. Yeah. So you could go at the peak. So you really need to avoid falling for such baits. Or gold, you just buy gold. But yet you need the anchoring, so you need to think through strategically without eliminating that there is opportunity, but you cannot bank everything on one side. So diversification is the way to go.
All right, thank you very much. Of course, diversification is the way to go. Now, we want to get into a number of questions, and some of them that have come in. We have one from Rachel Otete, who's asking what aspects to consider when evaluating one's risk profile. I think, Eric, you can take that. And also in relation to that, we have, I think this is Cool Karaoke, who's asking, what about risk factors of Eurobonds?
Okay. So let's start with the factors. Also, before I even answer that question, I want to add to what Elizabeth said about it's always not about timing the market, it's about timing the market, right? Because more often than not, if you are timing the market, you're already too late, because the hype has already occurred, people have already invested in, so you're coming in high. So just to distinguish, are you an investor or are you a speculator? So investor long term, speculator, you're always trying to time. So from a risk perspective, some of the things you need to look at, I think knowledge is one of them. Are you knowledgeable in what you're investing in? Or do you have a bit of acumen in terms of financial standpoint? Because knowledge allows you to see that if I look at this solution that is in front of me, do I have a bit of understanding around it? So knowledge is one factor when you're looking at your risk profile. Secondly, is also past experiences, because people read a lot. So you'll find, oh, my friend got burnt in this investment vehicle. So you anchor your information based on your friend's experience. So you also have to identify, are there past experiences which are giving me biases? Thirdly is liquidity. Liquidity means, what is my cash flow? Am I liquid? Am I not too liquid? At the stage of life I'm in, am I willing to park money for so long, or am I in a phase of actually accumulating and growing? The other thing is also from a point of one, knowledge, secondly, past experiences, thirdly, liquidity. So the other thing is also about what is my emotional, what do you call it, personality. Am I somebody who is very emotional, or am I somebody who is very tapered, a thinker? So there's a bit of risk profiling that goes around, which asks a lot of those questions. Because one, we say human beings make decisions factually, but more often than not, it's emotional. Most people tend to make the decision emotionally. So you have to also to look at, from an emotional perspective, how am I generally as a person, right? How am I generally as in a normal situation? How do I handle things? So try to balance the emotional bit and also the factual bit when you're doing your risk assessment. Second question was the Eurobond, right?
Yes. We have Cool Kaki who's asking, what about the risk factors of the Eurobonds? And also a similar question from Rajendra Tewari who's asking, what is expected return in Eurobonds?
Okay, so let me start with the second one first. So the expected return on Eurobonds, so Kenya has 9 of them. Like I said, as of now, we have 9 of them, different returns, different range. But from a tenor perspective, you're looking as short as 2027 and as long as 2048. In between, there are 7 others which mature at different times. From a rate perspective, you are looking at 7% on the lower end of the curve, all the way to 9.75% on the higher end of the curve. But then again, there are many of them within that spectrum. It's always a matter of what is my time horizon, which one do I fit within my scope. So in terms of the Eurobond, I think the concern that came in was largely in 2024, because there wasn't a lot of concerted effort in terms of concern, will Kenya pay that debt which was due in 2024? So that's when the whole Eurobond concern has started to come into the market. But you look at the steps which have been taken from then up to date. One, there's a bit more structured liability management from a government perspective in terms of, one, lengthening the maturities on some of these securities. Secondly, there's a lot more money coming back into the emerging markets. Because remember, just before 2024, there was a lot more money moving from emerging markets to the developed markets because the rates there were a bit higher. Now the reverse is what has occurred, whereby you have more money coming back into emerging markets. So that brings a bit more stability in terms of our debt securities are a bit more attractive from a point of investors' perspective. Thirdly is that you look at the last 3 or 4 issuances, we have been oversubscribed. So that is a vote of confidence. So when I issue a debt and I get more people wanting it than what I wanted, that gives a vote of confidence from that perspective. So 3 things have occurred. 1, there's a bit structured liability management. Secondly, there's a bit more cash flowing back into emerging markets. And 3, the vote of confidence from a lot of investors have come into place. But that being said, there's always a risk in any investment. I think the concern is that, can I accommodate this risk? And what is the probability of this risk occurring? Because anything is possible. The element of probability is what you look at. And as Mwenda said, government debt is one of the lowest risk from a payment perspective, because the odds of a government defaulting are very minimal, if any. Yeah.
All right, and I want to bring Mwenda into this conversation. A number of questions that are also coming in that I think, Mwenda, you can take this. We have Florence Muthe who's asking, can you anticipate similar performance of the equity fund in 2026, factoring in pre-election period? And also a similar question to that from Ruben Gishana, who's asking, what was Absa's equity fund performance for last year in percentage?
Okay. So last year, I'll start with the second question, and thank you very much for the questions. So on the equity fund last year, our performance was 40% in terms of return, which is of course significant. It's not just a double digit, it's actually a high double digit. As whether that can be replicated in 2026, a couple of things need to be looked at. One, economically, are we still stable? Do we still have strength? Are there risks that have shown up? We have discussed the risks. There are definitely risks that we are seeing from an economic point of view. But then again, corporates will take time before, the economic side will take time before it takes impact as well, and whether we're able to have an insulation against that, and we did discuss some of those items that have to do with inflation. So what are we seeing in 2026? One of the main drivers of any corporate's earnings is consumption. Are people spending? And we did discuss about your share wallet. How much are you spending in terms of your airtime? How much are you spending in terms of what you're buying? And then so we have had challenges in terms of consumption, and that of course has been a challenge, and there's no question about it. But 2024, 2025, we have started seeing the recovery of the same. A big way of bringing money back into people's pockets is debt. And it will be good for us to also speak about debt management, even as you receive your windfall. What do you do with it? Do you pay back debt? And the likes of such discussions. But then debt is actually a very good thing to a large extent. It enables you to be able to consume. And as you consume, then the corporate, of course, has a growth in revenue because you're buying from the corporate. So it all begins from the normal mwananchi. If this mwananchi has inflation issues, if this mwananchi has their income being eaten away by taxes, then the corporate will feel that pain. But if we have a bit of reprieve on the same, and they now are able to borrow at a cheaper rate and consume, then the corporate will also feel the same. The same corporate is also able to build, to buy cheaper and reinvest this money and to do a bit of R&D, invest further. And we have started seeing banks, of course, lending. And we do expect that lending to keep spurring consumption in 2026. That means, fundamentally, the institutions are still expected to perform well in 2026. Whether that transmits to the price is dependent. That's why we did talk about the fact that the market has changed significantly. We do not see a lot of foreign participation, which means we don't see a lot of capital flight as well. What retailers do, and what, I know you spoke about speculators, but speculators are good because what speculators do is they provide price discovery. You actually have transactions going on at all times, which means the fundamentals can be seen on the price. So if we do expect fundamentals to still remain strong, we still expect banks to perform well, we still expect Safaricom to perform well, we still expect ABL to perform well, then end result is, will we have a transmission? As long as we have proper participation of retailers, we have the same kind of market activity we have been seeing, then that will be transmission in the price. It may not be at the same level because remember these fundamentals have been transmitted in terms of price for the last 2 years. And you have seen 100% growth in the last 2 years. We may not see the same 40% level, but we will definitely see positive growth that should deliver quite a bit of return for you, even in 2026.
All right, thank you very much, Mwenda. And just some feedback on the conversation that we are having. And we have an interesting one here from David K, who says Absa needs to set an investment learning academy for its clients. Unfortunately, this information is not taught in school. And yes, David, that is exactly why we're having this conversation. So you're tuned in to the right platform. And this conversation is not just happening today. It's an engagement that will keep going on over different topics, just helping you to manage your inflows and ensuring that even as you're looking at making that investment, you are well informed, that you're well educated on some of these things. Now, Liz, I want to bring you into these questions. I want you to take a question here where we have someone who's asking, this is Isaac Karanja, who says, I want to learn where I can invest. If I have like 1 million or 2 million, where can I invest and also track my monthly returns or profit in this case?
All right. So David wants to invest 1 million shillings. Well done. I think that's where
Isaac, actually. Isaac Karanja. Yeah.
Yes, Isaac, well done. That you have already postponed consumption and you want to grow that wealth. So to start you off, I think I would say if you are a starter, and maybe we call them like newbies in the investment. If you're a newbie, please start with an investment that rewards you positive, because your investment experience will determine how you will relate with other investments in future. And investment pain or heartbreaks last a lifetime. That one you have to keep in mind. So if you are starting, ensure that you start with an investment that gives you a positive return, and you can see the return and you can feel it, and therefore you have emotional boost that indeed my money is working for me. What do I mean? If you take the 1 million and we take it to his equity fund, which is doing 40s, what he hasn't said is that equities go up and down. So equities can go down, and it could be that year that equities maybe make -10. Yeah. And you put your 1 million, and at the end of the year you come and you ask Elizabeth, so I put $1 million, what do I have? And I tell you, oh, at this point, we can see your portfolio at 900,000. It will break your heart, and you may think, this is what happens all the time, every time, and therefore it will rupture your ability to continue with this journey. So we tell beginners, let's start at money market, let us learn. Let me give you that return of 7.5% or 8%. Every month it's a positive, your capital is growing. And if you're a bit courageous, maybe you're young, I will tell you, David, you're young, and therefore I'll put 50% in money market so that I protect your fragile heart, and I'll take another 50% perhaps in a portfolio that is mixed between bonds and equities, and gives you a kicker in returns and in growth. Then as you mature, I'll transition you softly to other asset classes such that in the event in one period we suffer a negative, you actually have the resilience to know that it's a bump, we ride it, we move to the next one. So that's how I would look at it, but again, very personal. Let's talk about it when we have better details about your profile.
All right, thank you very much, Elizabeth. Now, there's a lot of interest that is coming from our audience, particularly on the Absa Money Market Fund. And Eric, there's another question here who says, for Absa MMF, this is Zipporah Muideri who asks, for Absa MMF, is there capital preservation? And also in relation to that, there's Keval Shah who asks, who do I speak to about this? Do you have investment advisors, or do I speak to my relationship manager?
Okay, so to give us the second question, so any branch, if you walk to any Absa branch, which we have over 84 in the country, you will get this information. They'll be able to link the client with our team from head office, or even some of the staff members in the front line have an understanding about our investment. They will be able to engage. I think at the end of this webinar also, we'll share our contacts from the Absa Asset Management team, so whereby again you can be directly assisted. If the client also has a relationship manager, we have a team of over 35 relationship managers, well certified in the investment space. They can have that discussion with the client. So there are various channels to which to access us, right? The first question was on the money market. Come again, please repeat.
All right, let me just find it. I think there was a question on capital reserves.
Capital preservation.
Yes.
So I think when Wenda was talking about what is under the hood, when you lift the veil out of these investments, what is there fundamentally? So you look at what our money markets invest in. Treasury bills, short-term deposits, and high-grade commercial paper. That, to a large extent, capital preservation is key, right? So to answer the question straight on, yes, capital preservation is the main focus, safety and liquidity. So you look at the underlying assets, the capital preservation element is very key.
All right, thank you very much, Eric. I'm just reading through Josephat Mumbura's question, and I think any one of you can take this, where he asks Absa structured notes. Number one, he asks, what is the average return on this? And the second question he asks is, what is the available leverage option on this investment, at what average cost? And 3, what is the average commission stroke cost?
Take it, yeah.
Okay, so let's start with the second bit of the question. Yeah. So there's no leverage. Leverage implies, for the audience, it basically means you take your investment, you borrow against that investment to reinvest in the same investment. So no, there's no leverage on it, but there's lending against it. So you can have a security, either the structured note itself or even a government bond, and you come to the bank and say, I need liquidity. So we can lend between 60 to 80% against that investment. So that is known as wealth lending, but that's not leverage. From a currency perspective, we do it in dollars and pounds. Return expectation is potentially higher than what is locally available, largely because a structured note is built for certain conditions and is built for certain objectives. So if your objective is income, it will be a very different structured growth form, one whereby growth is the objective, or whether generational wealth is the plan, or capital preservation is the plan. So I think we need to have a bit more engagement for us to give a percentage figure, largely because it depends on the need you're trying to address. But in essence, it's higher than what is locally available, especially from a USD perspective and a pound perspective.
All right, so Mwenda, I want to come to you with a couple of questions here. One is from Obadiah Sawa, who asks, do I need to have a CDS account, or can I just pass it if I want to invest with Absa MMF? How do I go about it? And also at the same time, you can also respond to Harry Chemjor, who asks, how can I register for CDS account with Absa? I'm based in Eldoret and I have an account with Absa Bank. Kindly advise.
Thank you. So let me start with just a bit of a description. Fund managers, we manage funds. What is a fund? In Kenya, they usually, by the law, it's collective investment schemes. I did give some of this indication, but what it really is a pooling of money for investment purposes. It is, in essence, just to get a bit colloquial, it's a registered chama. So we are bringing all of you together and using that money to invest in whatever form we have structured the fund for. So if it's a money market fund, it's structured for certain reasons. If it's an equity fund, for certain reasons. But what we are doing is creating a pool. Therefore, we act as your agent at any one time, so you don't need a CDS account to be able to come to us. What you need is an account with us, which is basically an investment account, a unit trust account. So once you open that account, then it gives you access to all our 5 products, because we have 2 money market funds. One is a Kenyan shilling, the other is a dollar fund. We also do have a fixed income fund, which invests largely in bonds. We have an equity fund, which invests largely in shares. And we have a balanced fund, as Elizabeth was putting it, that invests in both shares and bonds. So we have 5 funds. We give you access to all these 5 funds, which enable you to diversify depending on your objectives and what you want to invest in. And therefore, you do not need a CDS account, because we go to the market. We are the ones with a CDS account through a custodian, and the custodian is a different entity, and therefore it becomes a much less stressful kind of way of getting into the market without having to go through the hoops and jumps that the other forms do provide you. How can you get into it? Visit any of our branches. The forms should be available. Fill them out, and then you'll be given access to these particular funds. Put in the money and we invest it for you, and share statement every month.
All right, thank you, Mwenda. And of course, if you're still following this conversation, all this information will be posted at the end of this webinar, and also you can go back and watch the previous webinars and some of the information. If you need more explanation, some might have been issued in the previous webinars, so you can go back and watch them and learn as much as you can and equip yourself, even as you're thinking of making this investment decision. And whether you want to invest locally or you want to invest globally, you have options and you have experts to be able to guide you through that. And in relation to investing globally, Elizabeth, there's a question here from Ted Iro Opio, who asks, how can Absa support SEPA direct debit transaction from EU-based customers looking to invest in these asset classes?
All right. Repeat that again.
So this is Ted Iro Opio, who says, how can Absa Bank support direct debit transaction from EU-based customers looking to invest in these asset classes?
All right. I think what happens there, that's a banking transaction where you're able to direct debit directly back to Kenya. What happens is that your relationship manager will be able to advise on how that can be done, because that transaction, it's at the banking level before it can land at the investment level. So we will be able to facilitate that, because we deal with many international banks on transfers and that kind of thing.
All right, so Ted, there you have it. Of course, we got you. I mean, this is the bank that will help you grow your wealth even going into the future. So we have the right people to help you just navigate that space and make sure that you make the right investment and that your transaction is as seamless as it can be. Now, Eric, a number of questions that are still coming in, particularly on the MMF. And we have Charles Mwangi who's asking, what is your current rate on MMF?
7.48%.
All right, Charles, I think you've been answered there, 7.4 to about 8%. So if you're looking to put your money there, it's quite a good rate. And we have another question here from Isaac Tumuti, who says, can one open an investment account if they are not in the country but to have an account with Absa? Can one open an investment account if they're not in the country but have an account with Absa Bank? Mwenda, I think you can take this.
Yes, you can. We will share our contacts. Send us a request on email. We'll share the forms with you. If you do have an account in Absa, send the request to that particular, to us. Give us a call. We'll guide you through the same. Our forms that you need to fill are interactive. The KYC is straightforward. It should be something that you can actually quickly do the same. A copy of your ID, a copy of your PIN. Since you already bank with us, we do have a copy of your bank statement. But largely, if you do have a bank with Absa, it becomes a lot easier in terms of the onboarding and what KYC you ask for. It's just an issue of filling in the forms. You share with us, we open the account, and we always will communicate on email once the account is open. And the next thing is to load the account. Once you load the account, we invest for you, and we share monthly statements.
All right. Yeah, go ahead, Eric.
Answered. So also from a diaspora perspective, because presumably there are clients who are outside Kenya, so we do have a diaspora aspect whereby we have a team that handles sort of queries. So even if a client is not based here in Kenya, they're in diaspora, they're not an Absa Bank Kenya client, we still can do those sort of investments for them. So the investment is not tagged to you being a bank, an Absa Bank Kenya client. The investment is open to you by virtue of you being an investor, but we do have a diaspora desk which actually handles diaspora clients from a relational perspective.
All right, and Eric, I think another question that maybe you might want to respond from this is from Eric Nahama, who asks, can equities purchased directly from the market by an individual be transferred to your equity fund for better management?
No. Because, so you see, when you buy, what do you call it, equities, you can either go directly through a stockbroker, or you can go through a fund, an equity fund, right? So those are two separate, completely different ways of handling. There's no overlap in terms of the engagements. So if you go the direct way through a stockbroker, you buy the shares directly, that is managed by that line of the engagement. You go through us through a fund, that's another different engagement. So there's no bridging in between. Yeah.
All right, and still on this MMF conversation, and I think we might need to consider having a session purely just to try and explain how this money market fund works, because the amount of interest that is being generated from this conversation, and also just based on the responses that we're getting, clearly this is a topic that might need to be discussed at a later time and just be given, I think, a bit more time to have this. And I think so that we can move this conversation forward. Allow me to ask two questions, one from Anne Minor, who's asking what is the minimum amount that one can invest, and I'm not sure whether you're looking to invest in an MMF or you're looking to make a different investment, but you can just clarify that. And we also have Fauzia Abdallah, who says, I have a $1 MMF account with you, but I would like to invest the money in a more yielding platform. Kindly advise.
Okay. Thank you. And I'll take a bit of time just to explain some of the basics. So we have 5 funds, and that should be able to answer both questions. Out of these 5 funds, what we have tried to do is make them as liquid as possible, as homogeneous as possible. So first off, our funds have no lock-in period. Availability of liquidity is within 72 hours. In terms of minimums, for the Kenya shilling, it's 1,000 shillings across all the funds. Whether it's an equity fund or it's a money market fund, the minimum is 1,000 shillings. For the dollar money market fund, the minimum is $100. So if you have $100 or 1,000 shillings, you should be able to participate in any of our funds. And despite the assets, the underlying assets having different liquidity levels, we have managed them in a way that we actually can give you liquidity within 72 hours. So you should be able to get your money within 3 days, as and when you need it. We, of course, in most cases, will pay earlier, but the commitment that we have is 72 hours. So it doesn't matter which fund it is, you should be able to access that. And that provides you a lot of flexibility as a client, and also ensures that in case you have any decisions you need to make, you can make them knowing that at the end of the day, it's liquid. But we still must be cognizant of the fact that these funds, some of them are long-term, some of them are short-term, depending on the underlying assets are at any one time. What other options do you have in terms of dollar returns up and above the money market funds? You can we do give you access directly, as the amounts, of course, have been indicated, into Eurobonds, and we also do have structured notes that are dollar denominated that can be able to give you a return. So depending on what your requirements are in terms of risk and what amounts you're looking at, we can have a discussion, and we should be able to give you access to other dollar denominated assets other than just the money market fund that we have.
All right, thanks, Mwenda. So we have another question coming in from Jeremy Getau, who asks, what investment products would Absa advise a young professional with moderate risk appetite to invest in? And I think, Elizabeth, you can take this. And also, at the same time, could you talk to us about at what point should I then start considering getting into the global market?
Okay. So a young person, you're professional, upwardly mobile. So I'll add that one, upwardly mobile. Because I only want to wish them the best. Yeah. And you want to start investing. You already are clear that you're a moderate risk person. So first of all, make sure you have your, your emergency fund. You cannot ignore that one. That one is like the gospel. We start with that gospel before we take you to investing 101. When you start your investing as a young person, you have one thing that is working for you really, really well, your time. You're young, you've got a long time ahead of you, and that is the biggest benefit in investment. The time that you take your investments, live out when they are invested. And you can start however small, but the fact that you are maybe 23, 25, and you've got all the way to 60 before you can get to before you can get to retirement age, you can see the span of time that person has. It's amazing. That time gives you or gives me confidence to say you are a good candidate for equities. You are not a candidate for fixed income, for the simple reason that fixed income puts a limit to the returns you are making, because we are given by government returns of up to, in very good years, we got 18s. But naturally, governments, if you look at the US, 30-year bonds don't earn more than 5%. So if you were to normalize things and run this economy well, I'd expect that government returns would continue coming down, and therefore that cap means that your government securities or fixed income securities cannot give you that growth, that exponential growth that you're looking for as a young person. So I would say I'll take you to an equity fund, and you need to be consistent. As your income is growing, keep allocating more to equities, and at some point you transition also towards now offshore allocation still in the equities until you're a middle-aged person or you've got married and now you have more responsibilities and things like that. We start now reallocating back to fixed income because of the need for cash flows. And we also tell you about insurance, because that's something that you've got to infuse in your wealth journey, that you infuse both investments and insurance to protect, because you've got to protect the wealth, and you've got to protect for the uncertainties that may unravel in the journey of life. So insurance will come in at a later stage, but right now, have an emergency fund, move to an equity fund. If you really are afraid of equities, then go to a balanced fund at the least. Jump the fixed income for sure. I would want you to jump that one, but the growth will be exponential if you get exposure to growth assets.
All right, so there was a second part of that question, which is at what point should I start considering investing in the global market and in that global space? And also, could you just talk to us about how easy or what are some of the bottlenecks that I need to prepare myself when, let's say, I want to go and put money in a Eurobond, in a Eurobond rather?
Yeah, going to global markets, we consider it more for the complex investor who has built a portfolio that is geographically large, because and now their need is going beyond, because you need size when you're going globally. I really can't tell you to go globally with 1,000 shillings, that's $100. I can't tell you to do that, because magnitude really matters. We need to first of all build a healthy quantum of a portfolio before we can transition you to the global market, because largely our emerging markets are actually earning you more. And when you are going to the global space, we are looking for geographical diversification and maybe sector diversification, because some people will tell me, here you don't have AI stocks, which is very good, and it is true. So you're going for that diversification geographically. So having achieved a quantum of excess of, I think, Eric, you can help me here. It's not cast in on any iron. However, if your portfolio has reached 50 million plus, I would really consider moving you more towards the global space. Otherwise, let's grow you to a sizable level, which is local, and there are opportunities that are rewarding you handsomely locally, and then we can move you now to the global space. What are the hurdles that you need to prepare for as you go globally? More scrutiny by our governments, because our governments are becoming more interested with who has money and who is going where. So I can expect that as you move towards that, then your scrutiny, especially on financial crime and matters, anti-money laundering, that becomes more enhanced. And so do not be afraid to be asked for more details when you're going internationally to invest, because also as a country, we are protecting ourselves against, the unintended or the negative consequences of money laundering and things to do with, financial crime. So you become more, not targeted, rather of scrutiny, but doesn't mean that you're a bad person. Just be open-minded about it.
All right, and those are quite informative insights, because a lot of us, maybe myself included, those are some of the things that I wasn't aware, because I mean, we get stressed even by the normal KYCs here in the country. So if you tell me about more scrutiny, that might be a bit of a deterrent. However, it is still a viable investment. And for those who are still following this conversation, that email at the bottom of the screen, assetmanagementke@absa.africa. So for some of the questions that we will not be able to get to during this session, we will be engaging you at a personal level. So if you have any more questions that you want answered, that is the email that you can forward them to, and we will we'll make sure that we have a team to respond to those questions, and also just give you more details and hold your hand and walk with you even as you make that decision. Now, a number of questions are still coming in, and one of them is, and I think I've seen it a number of times, is whether Absa has a mobile app to be able to invest in a money market fund, and how easy is it? So, Mwenda, over to you.
Thank you. We do have a lot of work that we're doing. I'll give you the history of this institution. This institution has been around since 2019. Absa Asset Management was set up in 2019, started selling products in 2022. So we are a very new entrant into the business from an asset management point of view. The last 3 years, we have seen phenomenal growth, and thanks to you as our customers, you have truly supported us and set us apart as people who do deliver in terms of not just return, but that comfort and that optimism that you have with us as a new entrant. We're really happy about it. And we continue to make sure that we improve our services to deliver a lot more for you. We have a lot of work that we are doing, from giving you access to your investments and to be able to view them through portals, through mobile apps, and we do have work in progress that is being done. We do believe that we should be able to deliver that as well. But as an asset institution, we do have the clarity of the fact that we really do need to work on a couple of those things, and there's work that is ongoing, and delivery, of course, will be brought about. Quite a number of our customers as well do access the Absa banking services through their apps and their mobile and their portals. It will be good to, of course, add the other products on board. So we have work that is being done. Hopefully, towards the end of the year and through the year, we should be able to deliver a couple of those things, and we'll come back to you with what we have delivered. The request is well heard, has been there for the last 3 years. We are cognizant of the fact that we have quite a bit that we need to do, but we are committed to delivering this. Thank you.
All right, so those who are tech savvy and just looking for an easy and less a more convenient way of just making that investment. Of course, now you know that in the next, be on the lookout in the near future, that app will be in your hand, and then you'll be able to make those decisions and make those investments. Now, Eric, clearly with MMF, we seem to have touched a nerve, because the questions are still coming in more and more about this MMF. And one says, we have a question here from Anne, who's asking, can one have more than one MMF account? And also we have Vipul Chokshi, who has a question here on essentially how does Absa Bank MMF compare to other players in the market?
So remember I said one of the reasons why people open MMFs is goal-based saving. So you can have multiple MMFs based on the goal that you're trying to achieve. So let's say I want to pay for school fees, I have an MMF for that. I want to travel next year to, I was about to say Dubai, but I'm not sure whether, Dubai will still be a good place to go to. Dubai, I have an MMF for that. I have family events, so you can have multiple ones based on the goal that you're trying to achieve. And it's always prudent to have that sort of distinction so that you're never mixing money, right? Money for school fees is not meant for, it's not touched for travel. Money for travel is not touched by emergencies. So you can have multiple MMFs just to ensure that you're addressing different goals. The other aspect in terms of how do we compare to the market, so all our rates are published daily in the leading newspapers, and we are competitively priced. I think the key thing about returns is not always a matter of the nominal value, it's the consistency of the return. How consistent is this fund manager in terms of delivering the return, and how reasonable is he within the market space. So it's not always the outlier that should attract you. Yeah. That's usually based on the asset classes that this fund manager is investing in. And all these people are in this range. Where is my fund manager in this range? So we are very competitively priced, and if you can check even every other day in the newspaper, the Business Daily, Standard Media, and the Nation, we have ranked and we are competitively priced comparatively. Yeah.
All right, and Liz, I think you want to join in on this?
I want to make a rejoinder on returns and risk. And this is a conversation that every investor must have with themselves. And whenever you're presented with an investment, not only a money market fund, any investment, even if it is in your chama or any form of investment, even land, you've got to learn the relationship between risk and return. And it's a profile that is tested by economists, by financial people, and it is true, and it will remain like that. Yeah. So if you have grid that is showing you return on this side, and this on the horizontal, on the vertical you have the return, and on the horizontal you've got the risk, and we're starting at the 0 point, always know that at the highest point your investment will give you a high return, and it should map with a high risk. Yeah. A high return will always go with a high risk. What is risk is in investments, because risk is defined in many ways. In investments, risk means volatility, that is price moving up and down, that is a risk. Risk in investment means the risk or the chance of losing the capital, that is credit risk, that we may give your money to a counterparty who has promised us a return and not be able to get it back. We saw that happening in Ghana. I think it happened when we had the credit default by the government on their Eurobonds. They couldn't be able to pay, or even Sri Lanka. So that is credit risk. Or even back here in Kenya, we saw the Nakumats with the commercial paper where they had borrowed for short term. They said 3 months, 6 months, and they were paying 21%. That's a high return. It would have mapped with a high risk. And when Nakumat snowballed wrongly, we saw them not honor, or even ARM. So even big companies have actually had that risk, default and credit risk at the same time. Then the other risk that you look at is the risk of pricing, of course, that we go to the market and buy you a portfolio and the prices go up and down. And especially when they go down, that is when an investor will feel the pain. And that downward, that risk that the prices will come down will ordinarily be seen by naked eye when it comes to equities, because we can observe it in the stock market. In the bond market, you might not be able to see it directly. However, you need to remember that your bonds, the prices is actually priced like a share, and we price it based on the yields that are trading in the market. When interest rates go up, your bond prices will come down, and when interest rates come down, your bond prices will come down. So when you're looking at a money market fund, I am looking at investments that give me the comfort to promise my 20 or the 20,000 customers in our money market fund that come tomorrow, we open, all your money, you can get your principal back. That means I can be able to recall it directly from where I have invested and give you back your principal, and on top of that, pay you a little higher, an interest on top of that. That is a promise we are making to you in a money market fund. On the other side, when you come and buy an equity fund, I'm promising you that as your manager, I will research the 70 stocks that are in the exchange, select quality stocks on your behalf. They'll pay you dividend and I will be able to pay you back. But on top of that, we will be able to chase a capital gain that is commensurate. However, I do not guarantee, or I do not promise that I will not face market downturn. So it could be that a major catastrophe happens and the whole market, equity market goes down. I will also come back to you with an equity fund and tell you, unfortunately, this year was not one of the best years and your equity fund has returned a negative. So it has that ability to return a negative, but also an ability to give you a really high return in times that are good. But my work as a manager is to screen every security that we buy. Our research team does that so that we make the most credible, the most optimal return on your behalf without telling you that you will never lose, you will never, that would have to be a gospel which cannot live in investments. But for money market, we have committed to capital protection and an income on top of that. So we must protect you from default, we must protect you from credit risk, and we must make sure that liquidity is guaranteed, that when you come for your money, you can actually get it and we don't give you a story.
All right, thank you very much, Elizabeth, for making that clarification that yes, it is at the end of the day, we want to make sure that your investments are as safe as they can be, minimize the risk as much as we can, and ensure that you get the returns that you need to. Now, we're also sampling some of your feedback before I allow Mwenda to join in and jump into this conversation. We have one from Emily Ochanda who says, good insights, would be great to have a simulation of returns based on a diversified portfolio in future webinars to help us understand even more. And I think that is something that can be taken under consideration. Emily, and thank you so much for your feedback. Thank you for following this conversation and for participating in this conversation. It is such feedback that will help us improve and make sure that we address your needs even in the coming days. Now, there's a question that was coming in from Bakari Mwachukure, who says, what Sharia compliant arrangements do you have? Mwenda, you can go for it. Yeah.
Thank you. So I will go to the Sharia, but I wanted to make a comment on something that Elizabeth mentioned. She did speak about credit risk. As an individual, you also do have credit risk, and your credit risk is actually measured. When you go to a bank, they look at your ability to pay, they look at a couple of other things, and they actually do look at your credit risk as an individual. So debt management is one of the things that as an individual, you must look at it. We have spoken a lot about assets. It's important to also speak about the liability side of it. We have told you can invest in this, you can invest in that, but all these investments can also be funded by debt. They can all be funded by debt, and debt is not a bad thing. Debt is actually what gives you an ability to make your shilling go further. You get, what banks do is they get money from those who have, give those who need it so they can actually make investments. So this is from a business point of view, it's an individual point of view. So you need to think about how you manage your debt as much as possible. So when you get a windfall, one of the things that probably pops out of your mind is, I should pay a debt. And now that should not be the immediate reaction you have. You must think long term, and we did talk about the fact that you really must think long term. The question is this debt expensive or is it not expensive? So you need to pay off any expensive debts you have, and you also need to walk the journey towards being able to get cheaper debt. In other words, you need to get to make sure you lower your credit risk as much as possible. How do you do that? Create a track record. When you borrow and pay, that gives confidence to the person who is evaluating your next borrowing that you actually can pay the loan. It shows your ability to pay is actually there. You are willing to pay, and you have been paying debts in the past. So that ensures that as you progress onwards, then you actually can get cheaper debt. The other way to make sure that you work on your credit risk and lowering the same is the length of period. So as you lower your credit risk, then you are able to borrow longer and longer, which means for the same amount that you're paying every single month, you're able to get a lot more in terms of capital. You're able to get a lot more in terms of debt, and therefore you can push your savings harder and further, and you can make bigger and bigger investments. And once you pay the debt, whatever invested in remains. It does not go away. What goes away is the liability, and the assets remain. So debt is a good thing. It's important to have it and evaluate the same. So when you get your windfall, it would also be a good opportunity to be able to create a bit of a track record in terms of your ability to borrow and lamp up that with your windfall and buy a bigger asset, make a bigger investment, and progress onwards. Then finally, just to respond on the Sharia side of it, we have work that we are doing. The bank does have a Sharia unit. There is work that we are doing towards developing investment products for the Sharia institutions as well, and individuals as well. We should be able to bring that on board as we progress. Thank you very much.
Thank you very much, Mwenda. Now, Eric, a couple of questions, and I know you wanted to respond to the Sharia compliant products. You could also talk to us about, are you able to help customers to invest in U.S. equities such as VOO? This is a question that is coming in from Peter Chege, and also you can respond to Sharia compliant products.
Okay. So to start with the Sharia compliant products, to add to what Mwenda said, yes, on the banking arm, there is a Sharia compliant Lariba banking arm, which focuses on some solutions which could be of potential use for the client who has asked that question. But on the offshore space, we do have Sharia compliance structured notes. In essence, they start from $100,000 and above. And I think Liz alluded to, once you start going offshore, the quantum sizes of some of those investments start going up. That's just an Absa aspect. It's just the general investment scope that once you start going offshore, the quantum sizes on some of your solutions start going up. To the specific ask about whether we can do a specific VOO, is it an ETF? I think it must be an ETF. At the moment, that is something Mwenda is developing, that we can start giving clients access to the US equities market in terms of specific either ETFs or that sort of aspect. But in the interim, what we have investments which give you exposure to indexes. So rather than a specific share, you get a specific index, which, as Elizabeth mentioned, indices tend to be better from a volatility perspective because they're so broad. So it's not almost match and match, but there's some work being done on that side. But at the moment, what we have is equity-linked sort of investment vehicles, but not share-based investment vehicles. Yeah.
All right, now, Liz and gentlemen, I know this is quite interesting because for the last couple of over the last 1.5 hours, we've been having this conversation, and the truth is clearly it is resonating with a lot of our audience. And there's quite an interesting feedback here from Alfred Guchu, who says, I'm interested to put money in some high risk investment, but backed by the knowledge and expertise available within Absa. What options are available? I'll start with you, Liz. You can talk to us about the options that are available at a global market. Then Mwenda, you can talk to us about some of the local options that we might have. And also something else that Eric, I might need you to come in on is a question by, again, Cool Kaki, who asks, how secure is government bonds like Eurobonds and local shillings bonds? Liz, I'll start with you.
Okay, so if you want to go to offshore offering, the global ones, it is through structured notes at the moment. So you get structured notes from most part of the world. That's what we are giving, and different indices. So we only work with indices and global partners. The minimum investment is $100,000. But like you have heard, we are working on lower denomination to make sure that we democratize the offshore aspect and give more people that opportunity. But as it is right now, $100,000, it is structured notes, and they are all indexed.
All right, Mwenda, what are some of the local options for Mr. Alfred, who clearly his risk appetite has moved?
Yes. So we do have options and availability of the same. What we have done on the local market is ensure that we provide a diversified number of unit trusts that you can actually look at. That ensures for the high risk taker, the one who is looking for growth, the one who is basically able to wait a lot longer, then you can go into the equities market through the equity fund. And that fund enables you to participate in the economic growth that is expected as long-term, in the corporate growth that is expected as long-term. And of course, that comes with significant risk. As Elizabeth put it, you can be 40% up 1 year and you're 40% up the next year. It does present that kind of risk. But ours is to manage that risk and ensure that as much as the risk is high, we're able to insulate you from some of those challenges that the market does present. And that's the essence of the team. With 15, 20 years of experience in the market, we have an ability and a committee that sits to evaluate a lot of these decisions we make. So we are able to bring on that expertise that you're looking for and still deliver those high-risk items. The other thing that we are working on currently on the end in terms of spectrum for unit trusts is a special fund. What a special fund does is it enables you to take a lot more risk. The 5 funds we have are very structured in terms of what they can do. A money market fund has clarity by law as to what it can do, and there's no capital risk that comes with it. A fixed income fund, a balanced fund, and equity fund as well. Special funds is where you're able to develop whatever it is that you think you want your customers to see. Now, the challenge with that is that it also opens up to environments where you can take risk that the client may not have clarity on. So as Absa and the expertise that you're talking about, what we want to develop, and we're in the process of developing a special fund, is a fund that actually you can lift the hood and see what is inside and understand what is inside and have the clarity. The same thing that we have with the other 5 funds, we have a lot of clarity in terms of where is this money coming from. So we want to develop a special fund that will give you, yes, the high risk in terms of return, will give you the same exposure as you're looking for, will give you the returns that you're looking for, but with a lot more stability and a lot more clarity of what exactly are you putting your money into so that you can sleep at night. We do not want situations where you have invested your money and you don't know whether it's safe. We want to make sure, as Absa, safety is important, but we must also deliver the return. And as Eric has put it, all our returns in terms of our funds are competitive, and even the special fund will still deliver competitive returns even as we develop it. Thank you.
All right, Eric, to that question around how secure is government bonds, the Eurobond and local shillings denominated bonds, how secure are they?
I think Mwenda briefly touched on that when he was doing the comparison between corporate bonds and government debt. So anytime you hear the word debt, the quality of the issuer matters. Who is the person promising me? Because debt is, in essence, I'm lending money, and the other person is saying, I will pay you based on my credibility, right? So government debt, in essence, is deemed the lowest risk, largely because the backer of that security is the government, in this case, the government of Kenya. So unless there's a significant risk to that entity that is issuing that security, the debt itself is very, very, very secure, right? But the difference between the two is that the Eurobonds tend to be a bit more sensitive. Because of the dollar exposure, there's an element of it's a bit more impacted by global phenomena compared to the local shillings. So from a security perspective, it's the same issuer, but from a sensitivity perspective, the Eurobond, largely because of the dollar exposure, tends to be a bit more volatile or a bit more, how do we frame it, deemed higher compared to the local shilling. By the end of the day, the issuer is the same. So the security element is still the same across the board. It's just a sensitivity from an aspect perspective.
All right, so you can go ahead, but just before Mwenda jumps in, there's another question that is coming from Meshak Odunga, who's asking, can I borrow against what I have in an MMF, and to what extent?
I can take that as well.
Yeah, sure.
So let me take the second question, then I'll add something in terms of the issuer and their credibility and how do you look at it. So you can borrow against the MMF. It's actually considered a cash kind of security. So the same thing that you would get as if you used cash as security, then you should be able to get the same. Eric did speak about the fact that you can also borrow against bond between 60 to 80%, cash security between 80 to 90%. So you should be able to borrow against your MMF. You should be able to borrow against any bonds that you have with us. You should be able to borrow against an equity fund. Whatever funds you have with us, it's possible to actually get a facility against that. And that, as I said, that is a good thing. It enables you to be able to leverage, because that is what really it is. You have an investment here, leverage the same and buy more, or buy something else and build as you continue. So how do you evaluate the government in terms of their payment and whether it's secure, as Eric was putting it and was defining some of these things? One of the main things with governments is an issue of ability to pay and willingness to pay. We have come from a period where We have seen a government that was actually able to pay but unwilling to pay. That default was as a result of willingness, not ability. They did have the ability, they could get the support that they needed and would have been able to pay, but they willingly decided not to pay. And the thing with governments is a lot of that will definitely have an impact on the country, a significant impact. We have seen that countries suffer significantly, 50% inflation and a couple of other challenges that they have gone through. But Kenya's economy, as been put, Kenya is a bit different. The question you ask yourself when you evaluate is, do we have the ability to pay? I do believe we have the ability to pay. We do have the reserves that we have built over time. It's not an issue of ability to pay. And even during the discussions of sovereign risk that we had in 2024, it was always an issue of not being able to pay. But then again, governments don't pay debt. They refinance, especially developing countries. Why? Because even as a young person, and I always give this analogy, as a young person, you would not be able to save enough to buy that asset you're looking for. If, let's say, the piece of land or something else you want to buy is $1 million shillings, by the time you save the $1 million shillings, the price has moved. It's no longer $1 million shillings, it's something else. But you can borrow, fix the price of the asset, have the ownership, and deal with the borrower post that. So in a country that is growing and an individual is growing, then debt really does help you to drive your investment side. So at any one time, you'll find developing countries will be heavy borrowers, they will buy. They will basically be making those investments. That investment that you're making as well is what builds your ability to pay. As a country grows, then your taxes grow, which is what you're paying against, which is the income, because the taxes basically are the income. So even as an individual person, as you grow your pool of assets, then your income from those assets also grows. And as that income grows, it enables you to pay. And because ability to pay is not in question, depending on how you manage that debt, then the question is willingness. And I think we have had opportunity to see that willingness. And a lot of what we are seeing offshore and what we are seeing in terms of the ability to pay and willingness is what we are seeing in the oversubscription of Kenyan Eurobonds. And that continues. The other diversity that we have is that Kenya's local bond, Kenya is one of the most developed local bond markets in the continent. The local bonds that we have are largely owned, just like what you have seen in the stock market, are largely owned by locals. About 96% of that debt, by the numbers that we have seen, is actually local. So we don't have a lot of foreign participation. But when you go to Eurobonds, we have quite a big chunk of foreign participation. And that capital flight is definitely what brings that volatility that Eric was speaking about in Eurobonds, where else we don't have the same volatility in the local market. So depending on what you're looking at, but volatility is not a bad thing. It gives you an opportunity. If you do have a lot more sense of what the long-term view is and what the future is, then that provides opportunities for you to buy more. Entry levels. As prices come down for those who are running away from problems that they probably cannot estimate properly, then you come in and buy at a lower price. So it usually provides you, who has a lot more analysis and future-driven and long-term opportunities for entry, which is what volatility provides. Thank you.
All right, thank you very much, Mwenda. Now, I know we are coming to the tail end of this conversation, but there is something that I think we will have done an injustice if we do not speak about it. And this is the question around the tax breaks with some of these investment options. I know that there's some investment options that would also act and give you a tax break, that just because you have invested, let's say, in a certain fund or in a certain savings, you have X% in terms of a tax break. Can anyone of you, and this is an open question, anyone of you just take us through what that might look like? Because at the end of the day, what we're looking at is generating more revenue for ourselves while spending as little as possible.
Okay, let me talk about tax. So when it comes to the unit trust funds, the pooled funds are tax exempt, all of them. So everything that we are investing in the pool is actually tax exempt. Then from there, the Income Tax Act has guided the managers that if a customer who is in the pooled fund is taxable, we shall deduct 15% withholding tax on income, not capital gains. on the income that is distributed. So the income distributions from money market fund, from fixed income fund, and the dividends, we will deduct a withholding tax. That withholding tax is final. You do not need to file or to declare it at the point of filing your returns at KRA for an individual. For a corporate or an SME who is registered, that is different. The Income Tax Act defines that differently, and they need to disclose that they earned money from a money market fund or a fixed income fund, and they'll go a different route of being considered for the tax that was withheld by the entity. So that's what happens in unit trust funds. Now, for the bonds, we've got two types of local bonds that are sold by our government. So our government issues what we call fixed deposit fund, bonds, FXDs. Those are taxable. For any bond that is below 10 years, or even a treasury bill, the withholding tax is 15%. For any bond that is more than 15 years, at the point of issuance, not at the point of when you're buying, at the point of issuance, they charge 10%. So the longer dated bonds have actually a tax benefit for anybody who is buying. Then the other bond that they will issue is the infrastructure bonds, and infrastructure bonds will have a withholding tax or no withholding tax. So it's tax exempt. So they're usually very suitable for any customer who is a taxable person. So they're usually very nice in the sense that you're also saving on your taxes. So that's the kind of tax environment that we are working with. And for offshore, we advise that for any returns that you earn from offshore, your tax consultant should be able to advise you, because the tax authorities have not given very clear guidance there.
All right, and I mean, normally we are told information is power. So if you're looking for that tax break, remember, the longer the tenure, the better it is for you. So go for it and make sure that you take advantage of some of these breaks. Now, Eric, I want us to start wrapping up this conversation. Now, the other thing that I would really want you to help us understand, this windfall has come in, I've gotten a bonus of X amount. Where do I put it now? Should I start considering physical assets? Should I start going into the money market? What do I need to do when making that decision?
You're asking me whether I should buy a plot, yeah? It's a cultural thing. I think every Kenyan must have a plot somewhere, right? And we are cognizant that it's a culture, right? So fixed assets, I mean, which is basically real estate, it's not a bad investment, right? I think the key thing is that as you plan your investment journey, because there's no one shoe fits all sort of approach, the thing you need to look at, especially the most, is liquidity. Liquidity. How liquid do I want to be, right? And with real estate, you'll find with physical assets, the appreciation is there. Okay, it's deemed to be there, that it will grow up in price. Two is that it's secure, like it's a solid, I can touch it, right? And three is something worth bragging about, that I have, properties everywhere. Every weekend I'm going somewhere to see, right? But there are solutions which have come in the market which give clients access to real estate, but not in physical aspect. That you should see the I rights, the D rights. Those are now funds which invest in properties, but now you don't physically own the property. It's more liquid. So there is some aspect that is coming into play in the market in terms of how do we change the aspect of physical and non-physical. But the question at most is that, one is to sit down and say, what are my short-term goals? What are my medium-term goals? What are my long-term goals? So even as you deploy that money has a structured way of going. So I don't think it's an either-or sort of. Either can, it's both and, but it's an element of what do I actually need now, tomorrow, and the future. And how do I structure that way? Yeah.
Essentially, just look at what are my immediate goals and what are my long-term goals in making that decision. Now, Mwenda, I want to hear your final thought. Now, we are in a market where rates are coming down. We're in a market where what is happening globally is likely to bleed on us to a certain extent. So as we're making this decision on investment, as we're making that judgment on what investments to put in, what are some of the other things that that I need to look at, particularly in what is happening in the macro environment, to help me make that decision?
Thank you. And this morning we woke up to the news that the Fed has held their rates. We do we did expect that 2026 will still keep seeing economies, or rather central banks across board, cutting rates. The US has been one of the ones that has been aggressively cutting rates from 2024 to 2025. The holding of that rate this particular morning does signal to the risk that they are seeing across board. That risk is standard. What do we think you should actually be looking at? Watch out for inflation, watch out for currency weaknesses, watch out, because all that comes and gets transmitted into the rates, and which is the interest rates. Watch out for that as well. And as that is transmitted, then it does have an impact economically. So if you have at any one time just want to figure out where am I sitting, what is the future looking like, then really those are the items economically that you'll be looking at, whether locally or globally. And when you start seeing certain signals, like the ones now that we are seeing, that should tell you that we have a bit of heightened risk, yes. It doesn't mean there's no money to be made. Money is made from risk. But then your evaluation of risk does change a bit, and what matrices you look at will always be the same economic matrices that you look at, because that of course impacts the growth of the economy, which impacts the growth of corporates, and of course impacts you as an individual at the end of the day. Thank you. All
right, thank you very much, Mwenda. Now, Liz, you get the final word. When we started, you set the stage for us in terms of what's happening globally. We're talking about supply chain disruptions, geopolitical tension, and everything that is in between. As we go into the year, as we go into making these investment decisions based on, given that background that is currently happening, how then do we decide in determining this is what would work for me? And how then do we edge against some of these risks that are likely going to have an impact on us? And also, for those that are looking to go into that international market, that global market, is this the time, or should we reserve that capital for now?
These are very many questions to close a session. It feels like it's a repeat of the whole thing that we did. I think that, in a summary, I think in a crisis situation, like we have reiterated here, we need to first of all avoid emotional biases, because your emotional bias will impact the long-term decisions that you make. So do not panic. Don't go on a sell-off. I think that's what I would say. I know there are people who have already invested in equities, and maybe now they are feeling they need to be exiting in a half, or you need to chase oil, or you need to chase these others. So avoid emotional decision making at this point. Instead, evaluate your portfolio and structure it for for resilience into the future. We'll find clarity. It's definitely not as clear. It's still hazy. New money, I would say, if I had new money coming in, like the way we are talking about a windfall or a bonus, that new money that is coming, I would spread it across several asset classes and not one, but I would start at money market fund and then spread across, depending on your age, depending on your objective and things like that. Even offshore, the same thing. I think the whole idea about investing is ensuring that you're diversified. As Kenyans, it is imperative that all Kenyans think about their portfolios, because when we look at the structure of portfolios, you're either in land, money market, or now special fund. The in-between, something is just not happening right. I think it is a conversation that is national, that we need to diversify and start taking up asset classes that are balanced, and not just stay either on a very conservative side or a very illiquid side, which presents different risks. And one pays off maybe in the long term without liquidity, one pays less and gives you liquidity. You need the full plate. So look through and diversify to the extent that your money can afford, and the objectives that you have. That's what I would say. Don't be afraid. Don't watch a lot of breaking news. I told a group that please avoid breaking news, because breaking news heighten your emotions, and the next thing you make another bad decision. So yes, listen to news, but you can't listen to negative news in. Let your manager do that, because they must come to an investment committee and we stabilize them. That's what we do with this guy. He's an CIO. If emotions rise, he comes to the investment committee, presents all these, and then we filter the biases. So that is what the professional does. But when you're alone at home, the emotions can just heighten, and then you take decisions, and then you regret. We don't want to see you do that. So be careful how you react, but avoid short-termism and the lack of the long-term view to the future.
All right. You know, Liz, quite something interesting that you say there. If you tell them not to watch breaking news, I just be out of a job. I might be out of a job. So, so there is that. But thank you very much for following this conversation. Can you believe it? It's been already 2 hours of us engaging and having this conversation. This is not the last one. This is just one in part of a series of conversations that we will continue to have, and making sure that we equip you with the right information even as you're making those decisions. If you have any questions that you want answered, asset management at absa.africa. Asset management ke at absa.africa. You can channel those questions there, and we will be sure to get the right people to answer those questions and hold your hand, guide you even as you're making that investment. I want to thank each one of you who has taken time to follow this conversation and actively engage, actively send in your questions. I hope you've learned something. I know for sure I have. My name is Jimmy Mbogo. I have been your moderator for this session. I definitely do look forward to seeing you again. Do have a lovely afternoon. It is 12 already. Do have a lovely afternoon. And to our Muslim brothers and sisters, Eid Mubarak. Thank you for your time.
As women entrepreneurs, there is a gender discrimination. It is rife. And I keep telling people, if you are a woman business person, you have to be above average to be able to compete with the average men. They wanted us to show that we had the financial muscle to do the distribution, and that is where Absa came in for me. The outlets we serve are the ones that are 700. Absa came in handy. They provided loans, asset financing loans, and I got to choose vehicles, according to their performance. They have shared my dreams and taken risks with me, and that is why I am where I am today.